Hello, welcome to the weekly chart review. It's Monday, November 28th, 2016. I'm Selena Nicholas, technical analyst at xm.com. We'll start with the euro dollar on the daily chart. We can see euro USD halted its sharp decline. It was a strong bearish move that lasted about 2 weeks. From above 1.11, we saw prices drop below 1.06. But market reached oversold levels. We saw RSI falling below 30, and this resulted in a consolidation. We saw an 8-month low of 1.0517 touched last Thursday. Since then, prices rebounded to above 1.06 today. Although the overall short-term market structure is still bearish, so this move higher could be seen as a correction of the overall downtrend. We need to see how far the market will retrace this down leg that started from around 1.13. The barrier to the upside is 1.0850. Was an October low. It's an important barrier to the upside now, and then 1.09 needs to be breached if the bearish bias is to be weakened. But the bearish momentum still remains strong as long as RSI is below 50, and we're looking at the MACD being below 0. So both these momentum indicators are still bearish. So bullish momentum is not in the picture right now. We expect the bearish bias to remain. Let's take a look at the pound versus the dollar. It's looking neutral in a range. It's back in a range between 1.23, 1.25. So the pound has been shifting more or less from a range that was between 1.20 and 1.23. Back in October, it shifted higher to form a new range, 1.23. We did go up to 1.26 actually, but this sideways pattern has been going on now for the whole month. RSI, it's flat, hugging the 50 line, so this suggests consolidation is expected to continue in the near term. 50-day moving average now is acting as immediate resistance. It's around 1.25, just below it. So the overall bearish market structure that started back in September, it's still in place with consolidation going on right now. Market would have to rise above at least 1.27 in order to change the market structure to a more bullish one in the short term. Let's take a look at dollar yen. We can see that there was a strong bullish run, strong rally bouncing off the 103 area up to above 113. But this bullish run seems to have faded now. Dollar yen, after registering a fresh 8-month high of 113.89 on Friday, we're seeing prices reverse back down towards 111. We're finding support now at the 50% Fibonacci level. So this is important support. It was a long-term Fibonacci level. So this 50% retracement was of the decline, the down leg from November 2015 down to June 2016. So a drop from the 123.66 high down to 98.96. So this 50% Fibonacci level is now acting as support. The market, if we look at it back on the daily chart, we can see RSI, it's still in overbought territory. It's above 70. So we don't expect further dollar strength. Consolidation is likely, or a further pullback. 111, like I said, is important support. Market has to stay above this level or risk further downside. Let's take a look at gold. It's consolidating losses after falling below the key 1200 level last week. RSI fell to oversold territory under 30, so we're expecting consolidation or maybe a slight bounce higher, but of course 1200 is now strong resistance to the upside. The overall market structure remains bearish. Prices could fall back down and break below this 1170 area, and we could see a resumption of the downtrend to target 1110. If we look at crude oil now, very much in focus these days. Crude oil looks like the correction, the recent bounce higher, the correction of the downtrend from October seems to have ended. We saw prices turn back down again, probably going to resume the downtrend. We saw that resistance was found at the 61.8 Fibonacci retracement of the down leg from 52.21 to 42.92. So prices bounced, but reached this level, the 61.8 Fibonacci, before turning back down, and now we're at the 23.6 Fibonacci, around 45.09 right now. So this is definitely a near-term support level, and below this, of course, if prices see further decline, we'd target the 42.92 low, the November 14th low. And in order to see a shift in the bearish bias that we have now, we need to see a move at least above the 47 area. Otherwise, we expect further downside momentum, as RSI is still bearish. It's below 50, so it's in bearish territory. Thank you very much for watching, and have a great day.